are now live with our webinar. I can see Matt and Kate and myself. Okay, perfect. Well, thanks everyone for joining us today. To be conscious of everyone's time today, we aren't going to have a Q&A, but please reach out if you'd like to set up some specific time to go over any questions that you may have. I'm thinking this will take about 20 or 30 minutes to go through this webinar today. I'd also like to have full disclosure that we are not here to have political bias. Our job is to look at the facts and to look at the opportunities that are made available from those facts. So, last year has definitely presented some challenges. We had political polarization, social upheaval, a global pandemic, trade wars, a revolution in technology. People were learning to work from home. Moreover, parents were basically homeschooling their children. And while these challenges are definitely different from the past, we have always had some sort of challenges that we've learned to overcome. Though the song is more than 50 years old, Bob Dylan's anthem, "The Times They Are A-Changin'," seems just as fitting today as it was in 1964, except maybe the lava lamps and the folk music of the 60s aren't necessarily the hot trends anymore. But what is division and a desire to challenge the status quo still are. So with this seminar, we want to step back to provide some historical perspective for our investors. Okay. So what we want to do today is we want to look back at some monumental moments in our nation's history. And Matt and Kate and myself have tried to put a fun spin on this by breaking up each decade, starting with the 60s, and reviewing some of the challenges that we faced as a nation during those times and how investments weathered the storms. And we put a fun spin on it by relating each decade through the eyes of musicians. And then after we take a look back, then we will review some key takeaways from these times. And then finally, we'll discuss how those lessons should impact our investing strategies going forward. So we'll start by looking back to the past with the 60s. When the peaceful protests of the 60s turned violent, John Lennon responded with a song that supported change, but while rejecting violence as a tactic. His frustration with both the existing political structures and those who sought to overthrow them really continues to resonate today. The 1960 election gave us a young president and the promise of great things to come. We were enthralled by the first Super Bowl, the moon landing, and Woodstock. But on the flip side, we tragically had President John F. Kennedy, his brother Robert, and Martin Luther King were all assassinated during this period of time. So on this slide, and this is what we're going to do throughout the webinar, we're going to kind of show some of the crazy events that happened during that decade, and then we're going to show a slide that demonstrates how the markets reacted even with that chaos. And on this slide, we're focusing on the dark blue line that is represented as the S&P 500. So the Cuban Missile Crisis and heightened Cold War tensions caused a bear market in 1962. So a bear market meaning that we saw a downturn. But then you can see the market moved higher over the course of the decade. And this was really powered by what's called the Nifty 50 stocks. So, for example, GE, Coke, IBM, all that seemed to go only in one direction, and that was up. The 1960s was a decade of tremendous change, both politically and culturally, which is why some people are comparing the 2020s to the 1960s. But despite all of this turmoil, you can see that if you would have invested $10,000 at the start of that decade in stocks, it would have more than doubled by the end of the 60s. Now on to the 70s. After the chaos of the 60s, Marvin Gaye summarized American sentiment when he pleaded for de-escalation. The 70s brought us two energy crises, soaring gas prices and rationing, and the Nixon Watergate scandal. We had racism and poverty, particularly in urban areas, had remained widespread. But in some ways, relief did eventually come. The Vietnam War ended, and the era of the leisure suits and the disco had arrived. We had Jaws that made us afraid of the water, while Star Wars was really exciting our imaginations, and still does to this day. The feminist movement demanding equal pay and treatment really gained traction during this time. And for investors, though, as you can see from this slide, for investors, stagflation was the name of the game. And stagflation means that your dollar was buying you less, while at the same time, unemployment rates, a lot of people were without jobs during this time. Plus, energy prices quintupled, leading us into a deep recession. However, stocks, bonds, even cash did not care about any of this and turned ending the 70s in positive returns. On to the 80s, I'm gonna let Matt take on from here with the 80s. Thanks, Matt.
Awesome, thanks, Deanna. So when we look at the 80s, it was a time of great excess and great spending and great economic activity, but it didn't come without its stressors. And the economy was put under a lot of stressors. For example, the fall of the Berlin Wall and tensions with the Soviet Union. An increased technology that came out during the 80s meant that business became a lot more global. And we saw much more efficient trade between different countries happening, which brought on a whole set of new challenges that we were set to face. Additionally, the era of keeping up with the Joneses went into hyperdrive as these new technologies like cable TV, VCRs, video games, and even the personal computer all seeked a bit of jealousy from consumers as they tried to keep up with their neighbors. But when we look at the economy and how it did during the 80s, even with all those stressors, it really did exceptionally well. And although the decade wasn't without difficulties, to include two recessions, record inflation, and the Black Monday crash of 1987, which in the course of one day, the market lost trillions of dollars in the span of just hours. All of these things which dominated the headlines and created fear for investors in the short run, but yet the market not only recovered, but also delivered one of the strongest decades on record in the history of the market. And we see, $10,000 in the stock market would have turned all the way into $50,000 during the 80s. So a really successful year for markets, decade rather. Now, moving on to the 90s, the 90s laid the framework for the innovation in tech that we've seen kind of take over the marketplace as of late. The use of cell phones and satellites connected the world, and we saw new issues like terrorism become notable problems that required us to address. We also got to see probably the most widely accepted apocalyptic forecasts that failed to come true, as many people around the world were worried about the Y2K craze and how the markets would react if the computers were to shut down and everything came to an halt. Through all this, though, from an economic standpoint, one second here. The 90s were a great financial success. We saw dot-com companies coming out of the woodwork and growing like wildfire, but they also set us up for a bubble as we headed into the 2000s, with companies like Intel and Yahoo seeing record performance. Moving on to the 2000s, we began the decade with the dot-com bubble, and then soon after that experienced one of the most trying times in American history when we experienced 9/11. We entered heightened conflict in the Middle East, and on the sidelines, the smartphone began to take over the world. Additionally, we saw the worst stock market performance since the Great Depression when the crash of 2008 occurred. These events no doubtly shook Americans and the markets to their core, but let's see how hard the markets were affected. So, technology definitely burned many investors at the beginning of the decade with the dot-com bubble burst, and then followed just 8 years later with the great financial crisis. This brought severe and long-lasting results into the market. But when we look at how the market performed, a pure stock investor only lost $90, and we see how well a diversified portfolio really battened down the hatches and protected investors from those two major losses and all the turmoil that we faced from 2000 to 2009. And this was actually the worst decade that stocks had experienced ever that we came out of, going out to the 2010s. So I'll pass it over to Kate, and she can talk about how things occurred after that.
Thanks, Matt. So now we moved on to the 2010s, and this decade is being highlighted by the song from the hip hop musical Hamilton. And the song My Shot has revolutionaries rap about their own hopes for and reservations about the future. And one character raps, "Are we a nation of states? What's the state of our nation?" And as the beginning of this decade, we're dealing with the aftermath of the Great Recession with high unemployment and political polarization. But as the decade progressed, the presence of the internet proved to be both a blessing and a curse. And we entered an era of smartphone and internet dependence that both fueled and satisfied our hunger for viral videos, memes, and streaming services that let us binge watch entire seasons of our favorite shows. And while offering fun and fame, its anonymity also spread conflict, and we exited the 2010s deeply divided. In economic terms, the 2010s was kind of a mixed bag. Early on, unemployment remained high, economic growth was stalled, and the outlook was bleak. But as you see, as the decade went on, few could have predicted that we would have had the longest bull market and economic expansion on record, and it would last the entire decade, though the progress was slow and steady. The 2020s got off to a tumultuous start, to say the least. Presidential impeachment, protests against police brutality and racial injustice, record high unemployment, and a bear market. It's also been lonely as we've been socially distancing to curb the spread of COVID-19. Now, this decade is framed by Luke Combs' song, "Someday When We Aren't 6 Feet Apart," and it opines on all the things that we're missing out on, like going to concerts and hugging, seeing family, and negativity in the news. And more importantly, it highlights the mood of the country of looking forward to brighter days, looking forward to going to the movies, going out to dinner with the entire family and hanging out with friends. And while that can kind of put you in a somber mood, there is positivity on the horizon. Perhaps most importantly, 2020 provided us two important reminders about the market. Number one, it's resilient, and two, it's separate from the economy. Despite an economy that ground to a sudden halt in early 2020, the market set records in both the speed and the depth of its decline and the recovery that followed. By the end of 2020, unemployment came down from the record high of 15% in April down to 6.7% in December. Having a vaccine that has proven to be effective has put investors at ease as it signifies an eventual end to the pandemic. So what we want to do now is review some key lessons from our look back in history. So many investors were understandably anxious about the recent election, and some may have been tempted to make portfolio changes leading up to the election based on what they thought might happen, or if they were especially concerned that their favorite candidate or political party didn't win. But history has showed that investors have done well under presidents under both parties. And that dark beige graph at the bottom shows the S&P performance during the presidencies from John F. Kennedy all the way to President Trump. And in fact, with the exception of just two presidencies, each president had double-digit growth regardless of the crises that they had to contend with. From the Cuban Missile Crisis to the Vietnam War to 9/11, the Great Recession, to more recently with COVID-19, the market was still resilient. The market return was only negative for an administration when the country was in financial crisis or in a period of recessionary inflation that Deanna talked about. The bottom line is that neither political party can lay claim to superior economic or financial performance. And it's natural to think that today's problems are unique or unbeatable, but every decade has had its own serious challenges. Our nation has overcome insurmountable odds before, and we will once again. So our other key takeaway here is looking at the price of panic. So let's say you did get panicky during last year and you felt that urge to maybe pull out of the market while it was down. This slide is showing us what that cost of panicking is. So let's take a look at the reactionary investor, and they're notated by the red line. The reactionary investor started in 1960 with a $10,000 investment. And at each market drop, notated by those red panic buttons right there, that reactionary investor pulled out to safer investments and then jumped back in later. And that portfolio would have been about $466,000 by June of 2020. So let's take a look at a balanced investor, the light blue or the aqua line there. That investor is in a balanced portfolio. They stayed in the market and didn't panic at each market drop. They also started with $10,000 investment. By June of 2020, their portfolio was $1.9 million. So the bottom line is that letting your emotions drive investment decisions could do damage to your long-term financial health. I'm going to pass it back to Deanna.
Wonderful. So, gosh, it's just so interesting seeing that red panic button. And we often hear that, from clients that sometimes they just need to be talked off the ledge a little bit. But what I want to do is to review some strategies going forward, in particular, why we feel it's important to have a good blend of different investments, also known, you hear us say all the time, as diversification. From 1990 to 2019, so the last 29 years, 74% of the market's best days, so the best time to be invested, occurred during an ugly down market or within just the first 2 months of a market recovery. So when you're looking at this slide, that 74% is made up by the orange section and the dark blue section. leaving the rest of the best days to be invested only happening in bull markets, the up markets only happening 26% of the time. This goes to show that often the best time to invest is when we feel that we shouldn't be investing. Over this same 29-year period, if you would have invested $10,000 and stayed fully invested, so looking at this very first bar, you'd have around $170,000. So again, you invested $10,000 29 years ago and you didn't press the panic button. You would have had around $170,000. But if you missed just 10 of the best days, so you press that panic button that Kate showed us, just 10 days out of 29 years, you'd only have around $86,000. So that's 50% less by jumping in and out of the market. That's huge. A diversified portfolio can position your portfolio for both up markets and down markets. We all know that stocks offer greater growth potential, but bonds are there to provide income and to help us reduce the risk in our portfolio. When your portfolio is truly diversified, there will be times when part of it is doing great, but there's also going to be other times when the other part is underperforming and vice versa. So the bottom line is, it's clear that many of the challenges that we face today are echoes from our nation's past. That's why we thought it would be a good idea to remind ourselves of some history so we can gain perspective and see that the issues that we face today are in their own way different, but we are definitely not hopeless. As this perspective shows us, the American people, our economy, and our markets are resilient. It also shows us that investment success often has far less to do with what the markets are doing than what it has to do with our own behavior of getting nervous, and selling really has to do with it. So again, to be mindful of your time, we just wanted to provide this short webinar for you. We have also recently sent out a market update video that recaps just kind of how 2020 did and our thoughts on 2021 going forward. But we are looking forward to continuing to work with our clients and to hold your hands through the inevitable challenges that we're just always going to have. They're always going to be there. But Dylan reminds us the present now will later be the past. So thank you guys so much for your time today. I hope that you've enjoyed it as much as Matt and Kate and I did. And as I mentioned, if you have any questions, please don't hesitate to reach out about anything that we talked about today. But other than that, I hope everyone has a wonderful rest of their week. Thanks so much.